Hi traders, I want to talk to you today about having an off switch for your trading system. This is specifically relevant for day traders and day traders who are trading Forex, day traders who are trading indices and day traders who are trading stocks need to have an off switch that determines when a market is basically untradable. A market is never particularly or specifically untradable, but it's untradable based on systems that day traders very often use, home-based day traders very often use, and that work in most of the time. They maybe work most of the time, but they don't work all of the time. There is no particular system, irritatingly, that works all of the time in trading, and you need to tailor the system that you're trading at any one time to the conditions in the market. You'll have seen this from my previous videos. And the reason for this is because the volatility in the market, different markets, changes, and also the phase of the market changes. So a market moves from trends to trading ranges and trend channels. When it's in a different condition, it'll have different volatility and it'll require a slightly different type of trading. So most of you know that quite a lot of the trading that I do is on indices and specifically the DAX, and most of the time during the opening hours of the DAX it provides good trading opportunities, and not all of the time. And so I have developed an off switch for my trading, and for an off switch that I'd recommend for other traders who are trading in the same way. So for people that I coach, I encourage them to have to have a look at building into their system an off switch to say, okay, based on where the market is at the moment, I'm not trading. And so I'm going to talk about that particular off switch here. Now, when you're day trading, you're probably taking lots of trades, and you're maybe trading, you may have days where you take one trade, you may have days where you take 10 trades or even more. And it's going to depend on the market conditions and the volatility within the market. And how are you going to judge the volatility within the market? You're going to use the ATR, or average true range indicator, and you need to determine what the ATR is. Basically the size of the candle, so from high to low, what is the size of the candle, and the ATR is an average over normally 14 periods. So the reason that the ATR, the reason that volatility is important is because you're going to want a certain reward for the risk that you're going to take in the market. Now, if you're trading double tops, double bottoms, if you're trading head and shoulders, tops and bottoms, if you're trading pullbacks in trends, then they all have specific rules associated with those type of trades that you need to adhere to make sure that you're getting in and getting out at exactly the right time. And if the volatility in the market is too low, then it's basically not worth taking the trade, even if it's profitable, because of the charges associated with trading. Okay, so let me just illustrate that for you. Let's say here we've got a double top there. Let's say we've got a double top. So your double top is up here. That's your double top. And so basically on a double top trade, you're taking the trade as the market moves down below the middle of the double top. You've got a higher high, lower high, and you're taking the trade short there. Now, the risk and reward here. Okay, so you're looking at placing your risk above this high here, the second high, the lower high, and so your protective stop goes there, and you're looking for probably a gain of 1-to-1 reward to risk. So 1-to-1 reward to risk. And so that's going to be your exit, your target probably for that type of trade. Now, you need to make sure that these distances here are, worth taking the trade for. So what I mean by that is that every trade that you take has a charge associated with it. So let's say that this distance here is 2 points, okay, and your charge for the trade is 1 point, which is what my charge is on or what I pay my broker for every trade that I take on the DAX. It's 1 point. So if my potential reward is the same as my risk, which it must be in order for me to take the trade, and it's 2 points, and I pay 1 point of effectively of tax, or pay my broker one of those points, then I'm only getting 1 point reward, but I'm taking 2 points risk. That's not good enough for me, because it means that my win percentage has to be ridiculously high in order for me to be profitable in the long run. If, for example, that distance is 20 points, okay, I don't know whether you can see that very well, but that says 20 and 20. So the difference is 20 points. Then that's a different matter, because with a charge of 1 point, the percentage of charge to profit is low, and it means that I'm okay with the winning percentage that I need in order to take the trade. So I have, in my mind, I have a rule that says if this distance is less than 7 points, okay, so if it's less than 7 points and I'm paying a 1 point spread or a 1 point charge, then I get 6 points as a reward for if you like, a 7 point risk. That's the minimum that I'd expect and that I need in order to be able to hit my profit targets that I look for. So I need to check the volatility in the market. This is the volatility. What are the sizes of the candlesticks? How big are they from top to bottom? It has to be at least 7 points for me most of the time. 7 points, you'll all have your own views on this, and you'll all, depending on the system that I use, I may consider, and this is on the breakout candle. This is a 7 point breakout candle. The average true range that I look for is greater than 4 points. Okay, so that this breakout, or this double top mark, consists of 2 candlesticks, and so 2 times 4 is 8. So there may be a push up of 8 points there, that I'm looking to place my risk above that. 8 points below is my entry, and then 8 points below that will be my target for profit. I hope I made that make sense for you. So I'm looking for an average true range that enables me to take good profits. Now, let's have a look. Just have a look behind me now. I'll place in 2 charts. One is today's chart of the DAX, this morning's chart, and one is yesterday's chart. So on the left, we've got here, my left, we've got yesterday's chart, and here we have today's chart, and you can see, if you look very closely, you can see that the volatility, the average true range, was very different yesterday to what it's been today. On the chart yesterday, there were periods where you were looking at a 2 point average true range. That's over an average of 1 bar over 14 bars, and today you're looking at over 5, so that's double the volatility. And today's been a great trading day. The chart looks fantastic. Most trading systems that are profitable would have worked in today's chart. Yesterday was a trading range, and with low volatility in a trading range, You know, if you're trading a double top and the risk is 2 points based on the actual, you know, the way the trade looks, your broker won't accept that very often. The broker will, you know, if you're putting in automatic orders or bracket orders that allow your broker to set the risk will have to be probably 5 points, 4 or 5 points, based on, depending on the market that you trade. So you have to bear that in mind as well. So a market basically has to be moving. It has to be moving. There has to be fear and there has to be greed in the market in order for most trading systems to work. You know, my trading systems, I'm looking for setups here. I'm looking for setups here. I'm looking for setups in the double tops and the double bottoms. And these distances here have to be worth my while. You know, if I'm trading a pullback like this pullback here, then the minimum I expect to receive by taking my risk and placing my trade long here will be to reach the previous high. That's the minimum that I would expect. So this distance between my entry and the target there has to be worth my while. It can't be 2, 3, 4 points. It has to be worth my while. And you can basically look back on your chart and see what's happened. You know, when the market's broken out last, what did it do? Did it zoom off in one direction, or did it actually reverse before the breakout took place? Let me show you what I mean by that. Let's say you've got the market and it's doing this, it's going up and down, it's going up and down like this, and then it breaks out here. Now, this is a breakout of a horizontal level there, and the market's broken out. What does it do? Does it go up like that and then go down? That's called a false breakout, and it traps most traders out who are expecting the breakout. They trade the breakout, go long, and it traps them out, and people make losses in that sort of situation. That's what happens in trading ranges when there's low volatility normally. And, you know, or does it do that? Or does it zoom off up here for 10 points or 20 points? You know, what is the market actually doing? What has it done in the past? Because that is worth trading. When it's done that in the past, the chances are, you know, markets have inertia. They tend to do what they've been doing in the past. So if it's done that in the past, it's likely to do that in the future, you know. Comes back, more consolidation, breaks out, gets you another 20 points. And this is what markets tend to do. They tend to just repeat themselves. They go through phases based on what's happening in economies, what's happening in other markets, and you know, this is the same for individual stocks and shares. You know, most stocks and shares don't move. They just, you know, they just tick along. You know, if they're going up, they might do this. Well, you know, with a slow, you know, a 50-cent gain, is that worth my while trading that? No, it's not. But if one day you've got a stock that's been doing this and then it does that, then when I'm joining it in the morning and it's here, yeah, that's probably going to be worth looking at, because it's going to be going like this. Hopefully. We get on the right side of things. You're understanding my gist. These are, you know, have a look at the, you know, the average true range, and if the average true range in the time frame that you normally trade isn't correct, then you may have to increase the time frame. If you normally trade 1 minute, 2 minutes, 3 minutes or 5 minutes, you may have to increase the time frame that you're looking to trade over to make it worth your while from a risk, reward and fee perspective. My name's Anthony Beardsall. Hope you enjoyed that. Hope that made a bit of sense to you. Start thinking about developing your off switch. What is the, you know, have the ATR indicator available to you. don't always have it on your chart because you don't need it. You can see by the size of the candlesticks most of the time. But you know, what are you going to use to judge whether or not the market is going to be in a tradable frame of mind for you based on your system? My name's Anthony Beardsall. I look forward to joining you again on another video. Hope this one proves useful to you in developing an off switch for your trading, an on and off switch for your trading. I'll catch you on the next one. Cheers for now. Bye.